In this video, I'll take a look at defining the trend, which can be done a multitude of ways. I'm going to look at some of the most basic and common ways to do it, and also give you a heads up as to some of the common pitfalls that retail traders will fall into. So in front of you, I have the Euro-Yen monthly chart. It's an extreme example, but it gets the point across. So during this time frame, from 2002 all the way to 2007, you were in an uptrend. And yes, I realize that we had the occasional pullback, but prices were going higher over the longer term. Prices tend to either rise, fall, or consolidate. And we were rising, we were consolidating, we were falling. We rose slightly, we consolidated, we fell, we rose slightly, we even consolidated down there. We bounced pretty significantly, and then you can see we have consolidated down here as an example, rallied, pulled back, consolidated here, and so on. So really, markets can only be in one of three states. And once you identify the state, then you know the direction to trade. So let's take a look at, let's go to the daily chart. And if you click on the line tool and you click on a point on the chart, you can see that I'm drawing what is known as a trend line. A trend line needs to be touched at least 3 times. It can be up or down, in other words, support or resistance. So here it was resistance. It was a down trend line, if you will. And it was an uptrend line here. Now, I would caution you about relying too much on trend lines. Because if you remember in the video with support and resistance, the one thing that I kept pointing to was that there were specific prices that markets tend to pay attention to. So for example, just eyeballing it here, I'd say right around 124.50 to 125, there was a pretty significant area of support and resistance here. If you remember that, this is support, that's resistance. We broke above it, we came back down and tested it. Now notice something. This trend line that has been touched more than 3 times, and a lot of people will look at as a way to gauge the trend, also coincides with support and resistance. So that's the most important type of trend line touch that you can see, because you have fundamental traders who decide the euro is a value at 125 yen, and you have technical traders who see this resistance as now being support, and then you have the trend line traders. So you want to stack up as many things in your favor as possible. So that's the first thing that I would draw your attention to. Like, simply trading on trend lines hard, because you never know when it's going to break. That being said, this is a market that's climbing. There's really no arguing that. But if you don't, if you rely solely on trend lines, I'm about to show you something that your eye is probably pulling away from and not paying attention to. And that's this trend line. You can see we rallied, we pulled back, touched several times, we pulled back, touched, and then finally broke down to find this other trend line. Notice how this previous trend line is now offering resistance, much like that support and resistance horizontally. The biggest problem that you're going to have is, as we look at this, I can make a trend line there, and it doesn't look like much, but look at this trend line. This was, almost a month. So with that being the case, trend lines should be thought of as a guide. I would not get too excited by them, because think about the big money that moves the market. They look at this market and they say 125 is an area that we want to get long. We want to buy euro against the yen at 125. We think it represents value. We have models, fundamental models, that say it's going to, like 135 or whatever. Now, contrast that with the retail trader that is looking at this, sees this break, and they say, okay, well, maybe this line is the one we're following. And then we get to here and they go, well, wait a minute, we're starting to rise here. So it's a guide. It just kind of shows you which direction we're going, the strength of the trend, the angle of the trend, which is something that I would talk about trend lines as well, because you could make a trend line here, right? 1, 2, 3, 4. You can make a trend line here. But notice how that's much steeper than this one, and it fails. Now, why does it fail? Well, it fails because momentum can only keep up for so long. It makes sense. Only so many people are willing to step in and buy. There does come a point where they run out of momentum. So if you are going to use a trend line, you want to see one that is much more stable and just kind of 45-degree, maybe even lower, which is basically what we have here. So that tells you you're in an uptrend. So that right away tells you should be buying, not selling. Yes, you will get the occasional pullback, but who cares? In the big scheme of things, it does not matter. After all, if you think about it, a trend can be defined by what I'm circling here. There's a low, there's a high, there's a low that's higher than the previous one. There's a swing high, it's higher than the one before it. There's a swing low, higher than one before it. Swing high, swing low. At this point in time, you tested the trend line. It was a little choppy, but you can still see that overall, the overall attitude's higher. So with that in mind, that tells you a way to look at the trend through trend lines and just market structure. Higher highs, higher lows. Same thing would be over here, or if you were in a downtrend, high, low, high, before we eventually turn around. So you get lower highs, lower lows in a downtrend. Works the exact same way. So one problem that a lot of traders run into is they get too hung up on, and you'll hear this, especially in the forums, well, the 15-minute trend, the 1-hour trend, the monthly trend. There is only one trend. Don't let people get into your head with that. The monthly candlesticks are going higher. We've had several positive ones in a row. It's an uptrend, period, end of story. You look at the weekly chart, same situation here. We have been rising for quite some time. Now, there are what they call pullbacks, but at the end of the day, we still have higher highs and higher lows. The thing about trends is they end eventually, and there's no real way to know when that happens. Anybody that tells you anything different is lying to you. There are ways to define when you believe it's over, but anything can happen in the market, so you have to keep that in mind. As an example, as I'm looking at this chart, I see an area here that is obvious resistance, as it was once support and then resistance, and that's right where the market's at. Is this the end of the trend? I don't know. But it's clearly an area that you have to be worried about. And if you were long of this market already, then, maybe you're taking profit. Nonetheless, it could slice right through it, because I could have said the same thing about this area. This is an area that mattered, and you can see we broke through it. So you just don't know. But it tells you when to get out, I guess, is a good way to look at it. If the trend line gets broken, we fail here and we break down through some support, then the trend changes and you start to look in the other direction. So this is the weekly trend. This is the daily trend. We already looked at this. This is the 4-hour trend. But what happens is day traders especially are vulnerable for this. This is a 15-minute chart. And you can go through and you can say low, high, low, looks a little bit higher here. So we're in an uptrend, we're in an uptrend, a lower low, lower high. We break here. That confirms that the trend has changed. And that is true, except it's the 15-minute trend, right? So look how bearish, how negative this looks all of a sudden, right? Now watch what happens when I take this very negative looking chart and move it up to the 4-hour time frame. Well, at this point, it looks to me like the trend's trying to hold to the upside. So which side would you rather be on? And that's why you positively, absolutely must pay attention to the longer term time frame. What you want to see, and this is a good example of it, monthly, weekly, daily, 4-hour, all look bullish. Even the hourly, you can start to see that it's trying to recover. But you want to see multiple higher time frames working in the same direction. There's no way to guarantee that your trade won't get stopped out. Things happen. But as long as you stay with that in and of itself, and money management, risk sizing, are the two main things to remain a profitable trader. Except that there is a certain amount of randomness to trading, and you just never know when it's going to hit. But if you go with the overall flow of money, longer term, the markets will be much more forgiving. So the other way that a lot of people will look at trends beyond trend lines and structure and higher time frames working their way down is going to be moving averages. So I'm going to go ahead and insert a moving average. And you can see, I click on moving average. I choose exponential or simple. There's some other variations, but a simple moving average plots a line on the chart. And all this is the average closing price over the last 50 candlesticks. So what it tells you is over the last 50 candlesticks, we continue to grind higher. As long as that's rallying, going higher in price, the market is considered to be in an uptrend. You can use exponential. Exponential just puts a little bit more mathematical weight on, the latest candlesticks. It moves a little quicker. It changes direction a little quicker. But at the end of the day, it does not. And some people think of this as heresy, but in my 15 years of trading, I haven't seen a discernible difference between simple and exponential. Not enough to make a major difference in your trading account. And this is a 200-day EMA. A lot of times people we use for longer term trends. And you can see that it was in a downtrend down here, and then in this uptrend here, they crossed. Some people will even use this cross, the 50-day EMA representing a shorter time frame, showing that momentum is building to the upside. Notice how the two moving averages are spread out, so that means we're in a very strong uptrend. So there's a multitude of ways that people will use this, and there are entire systems built just upon moving averages. But notice how much like a trend line, this has offered dynamic support. Every time we've got closer to the 50-day EMA as of late, we've seen buyers come in. Warning, it's an optical illusion. And the reason I say that goes back to the uptrend line. Look at how high, wide, and handsome that trend line is. But again, notice how we had a trend line here. And we had a trend line here. The 50-day EMA had nothing to do with any of that. So I would be very cautious about counting on the 50-day EMA as holding. And quite often you'll see the market dip a little bit below. There are algorithms that track certain moving averages, and that might be part of why they somewhat work. But keep in mind, this part here and this part here, it's based upon the last 50 candlesticks. It's not, there's nothing inherently supportive of it other than people use it as a measuring stick. So again, gives you a general idea. Some traders will simply decide that the 200-day EMA determines the direction I trade in general. They also want to see a slope. So for example, this area here, it was, let me go ahead and take off the auto scroll. There we go. This area here was relatively flat. So the 200-day EMA itself wasn't defining a trend. Now, as it starts to slope higher, it most certainly is. So somewhere around here, you started to see that increase. And that's why quite often moving average traders or people who use a moving average as a guide stick, they'll also use like a 50 or a 20 or something like that. The periodicity doesn't really matter. I've seen people use, 34 because it's a Fibonacci number. I don't know that leads any more credence to the moving average itself. But at the end of the day, your takeaway should be that we are going higher over the longer term. You should be aware of the fact that the 200 and the 50-day EMA can cause areas of support and resistance and etc. But they also get sliced through. You can see how we sliced through it a couple of times. The angle matters more than anything else. And then you look for support based upon, so here, 50-day EMA, we dipped just below it, but we're sitting right here in the middle of that same support level that I had talked about during the trend line. So now you have 3 reasons to get long here. You know, the whole idea of trading is you're going to try to put as many things in your favor as possible, accepting the fact that it very well may not work out, even if you have 12 things going on. So with that angle of the 50-day EMA, the technical trader will recognize that at the very least, regardless of what else you see, you don't want to sell the market. And by measuring the tendency of the market over in that case, the last 50 days or the last 200 days, you recognize that the inflow, all things being equal over the longer time, is to the upside. So it keeps you on the right side of the trade. Some traders will look at they would say, okay, this is where the trend changed. I would also make the argument that we broke through a lot of resistance here and we came back down. So this would have been a great way to lose money. Trying to guess here, you may have gotten a lot of profit. Now, here's a candlestick here that perhaps, may have caught your attention as it is a shooting star. It's a very bearish candlestick. And of course, we had gotten way ahead of ourselves. So a little bit of profit taking there. But nonetheless, moving averages, again, should be thought of as a guide. They should not be the be-all, end-all of your system. It's just another thing, right along with trend lines and higher time frames, that point you in the right direction. And then you look for trading patterns, support and resistance at prices, candlesticks that perhaps give you a clue, etc., etc. The idea is these moving averages keep you in the trade longer, and some people will even go so far as they play off the 200, and then once they see this 50 hold, maybe they'll add to the position, which can be a huge difference between those who win and those who lose longer term, if you're willing to add to your winners. And that by far is one of the things that can really clean up a lot of messy trading in your trading account from previous sessions. I hope you've enjoyed this video. I hope you've learned something, perhaps a new way to look at trends, to realize that trends are very messy, much like life, and to realize that you will hear a lot of people talk about trend lines, moving averages, and the like, but the reality is, at the end of the day, what truly matters is direction of the market, momentum, if momentum gets a little overdone. A lot of times that volatility has to die down. Markets can only go crazy for so long. And then, of course, price. Price is by far the biggest thing. These are guidelines, nothing more, nothing less, but you never plan on having long-term success if you bet against the higher time frame trends, which is by far the biggest lesson in this video. Thank you for watching, and I'll see you in the next one.